The GCC is an important part of the emerging market universe, but there are a couple of differences. I think first is the quality. So we are talking here about the higher quality part of the AM universe. In general, the GCC is still solidly investment grade, so that's an important difference. I think the second one is also the pace of issuance. This is a region that is issuing a substantial amount of debt. It is going through a fairly rapid transformation of its financial markets. And so today represents, more than 30% of the flow of dollar bonds or dollar sovereign bonds coming out of the emerging market universe. I think also third is the policy framework is very orthodox and is moving in the right direction. So this is a region that today has the right policy framework, I think, to deal with the challenges around, their finances or fiscal consolidation efforts, but also a very encouraging structural reform trends, and now also the transition to a low carbon future. So we think they have a fairly coherent strategy that is meeting, I think, the increased demand from investors for ESG related risks, for more transparent and better regulated financial markets. And so I think this policy framework is an important differentiator. And then finally, I think the fourth difference is the opportunity to generate alpha. This is still a widely misunderstood and underinvested region. And so we think that this provides a lot of opportunity for investors that are focused, that are on the ground, that are really able to add that qualitative dimension to their research. So this is a significant market when you consider the depth and breadth. We're talking about over $600 billion in total issuance over the recent past. We're talking about more than $120 billion in issuance year to date. But also we're getting a very wide diversification in terms of the types of issuers. So you have representations obviously from sovereigns, from utilities, from airlines, banks, and then a number of other sectors. And so that allows us increasingly to build, more diversified and more resilient portfolios. And I would also say that the size is significant. When you consider that relative to the emerging market universe, this is over 20% of the index. But even if you consider or compared it to developed markets, I mean, this is larger than the Swiss bond market. This is larger than European high yield, for example. So there is a very rational explanation for investors to really allocate a significant portion of their assets to the region. And this is why we think that it's a very good complement for global bond portfolios and emerging market debt portfolios. Performance has been one of the more attractive attributes. Over the last 3 years, the GCC has delivered some of the strongest risk-adjusted returns. And even in the recent past, we think it's actually done quite well. So much so, in fact, that when we look at our mean variance optimization models, we find that adding GCC bonds into global portfolios tends to reduce risk as well as contribute to returns. So this is actually a unique, I think, advantage. And this is one of the main reasons why we think that investors really should consider the benefits of adding GCC bonds into their global portfolios. It's also somewhat counterintuitive that adding GCC debt, in fact, reduces your portfolio risk, because the common misconception is that this is a risky region and adding GCC bonds will increase my risk because it's somehow correlated to oil or it's a volatile region. But the reality is, and the numbers support it, the evidence supports it, that in fact adding GCC bonds tends to reduce your portfolio risk because of lower volatility in general, but importantly, low correlation to other asset classes. The outlook is probably more encouraging than it's been in a while. There's a couple of reasons for that. I think first, and one of the more obvious reasons is that we've seen this nice recovery in oil prices, and that certainly supports the finances of the governments across the region, and that does feed through into banks and other corporates. But I think also the way the policymakers in the region have handled the public health crisis of the pandemic has also been one of the brighter spots. So whether dealing with the original lockdown or dealing with the subsequent sort of testing or more recently the vaccination drive, the region has actually done very well on a global scale. And now we're beginning to see the fruits of that in both improved mobility numbers, in a V-shaped recovery for the region, and now a much more brighter outlook for tourism services and other important sectors. And so when we think about the oil price, we think about the reopening, we think about the vaccination drives, all of that points to much healthier fundamentals going forward. So Fed policy and the upcoming tapering has certainly been a cause of concern for many market participants. We're of the view that that's already quite telegraphed. We don't think it's going to have as dramatic an impact. We would also go so far as to say that this is very much a dovish Fed, which is in contrast to the Fed that was quite hawkish in 2013. So we don't see the same dynamics playing out over the coming 3 to 6 months. We would think, if anything, that rates are going to be broadly stable. We do think that inflation expectations might actually come down in the future, so that could have an impact on real rates, which we will certainly be monitoring. But by and large, we think that the outlook is pretty constructive. The correlation to oil prices are perhaps counterintuitively negligible. They're zero. Over short, medium, or long time frames, GCC bond markets do not react to the price of oil. Longer term, sure, they have a very important impact on the fundamentals, on policy, and in that sense, we have to be aware of what's happening in the oil market. But day to day or short term, it's not something we think investors need to worry about. Longer term, we think that there's some very exciting developments. And this is, again, something that's, I think, broadly misunderstood, because as we now transition to a low carbon future, there is a misconception that the region is not well equipped or somehow will suffer more than other regions as the world starts concentrating on greenhouse emissions and moving to a more sustainable or low carbon future. But that's actually where we think the region is particularly well placed. And we think that's the case because you have the largest emitters in the region, which are the government, the national oil companies, and the utilities. All of those are still in government hands. And now that we have policy in place to really focus on reducing the carbon emissions from the production of hydrocarbons, as well as from the production of electricity, we think we have a very symbiotic, collaborative, and we think holistic approach to a cleaner or more sustainable future. And so counter to what many people think, investing in GCC bonds is actually going to help facilitate the world's transition to a low carbon future.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。